is Barry Knapp with Ironsides Macroeconomics. You'll be receiving this podcast or viewing this video on Monday, December 6th. It is now Sunday night, December 5th. S&Ps are rallying a little bit following a crypto crash over the course of the weekend. Oil's rallying a little bit, and the bond market's not yet open. Tis the season for Outlook notes from macro strategists and economists. And so we wrote and released our 2022 Outlook. It was titled Inflation, Policy, and Politics. Thus far, we've received quite a bit of feedback. It appears we're getting quite a few eyeballs on the report. We also were interviewed for a podcast with the guys from the Market Huddle on Friday night, and that has triggered a very good response as well. A link to that podcast is contained in the email around our audio summary of our 2022 Outlook. So by all means, have a listen. That's quite a bit longer than our typical summary of our notes, but nonetheless, you might find it interesting. There's 4 sections to this week's 2022 Outlook note. And recall, we're going to write 2 more Outlook notes, a thematic longer term report next week, and then a market 2021 market in review note the following week. To some extent, we write that to try and help you write notes to your clients if you're so inclined or that's part of your process. So there are 4 sections to the note this week. The first one is a market environment outlook note titled Liquidity Trickle. The second section is our economic outlook. That's titled Persistent Pandemic Effects. We then wrote our policy and political outlook section titled Inflation, Policy, and Politics, which is the title of the overall note. And then our asset allocation outlook for 2022 was titled Another Difficult Year for the 60-40 Stock Bond Model. Let's begin with a liquidity trickle. There is going to be a vast difference between the beginning of 2022 and the beginning of 2021. And to some extent, this is precisely what we're seeing in the markets today, is the liquidity environment has inflected negatively. We've written a lot about this in the second half of the year, and it's become very apparent. You can see it in the carnage and the high valuation stocks, in the Bitcoin crash over the weekend. Markets are struggling with this big inflection point in liquidity. So let's just go back to the beginning of 2021 and think about what the environment was like. The Treasury had $1.7 trillion in their general account, and they were targeting bringing that down to a couple of $100 billion. They sent checks out with the bipartisan omnibus spending deal that was done at the end of the Trump administration. They sent another $400 to $500 billion in checks out when the American Recovery Act was passed on a partisan basis by the Democrats after they won that two shocking runoff elections in Georgia. Then they cut Treasury bill issuance. This all caused bank balance sheets to swell from something like 1.1 trillion in cash assets at the beginning of the pandemic to 3 trillion round about August of this year. We'll come back to the implications for banks. It's important when thinking about the difference about what this means for the economy versus what it means for the market. In addition to the Treasury general account process and all those transfer payments that were going out, that there may be some small transfer payments that go out as a part of the Build Back Better plan if it does finally get passed as we expect. Still, the numbers will be much smaller. You had the Fed buying $120 billion per month through the bulk of 2021. We expect that those purchases to be done by March or April, and they may very well go straight to balance sheet runoff. There are a Fed governor and Fed bank president advocating for that, and probably some interest based upon how inflation develops between now and the end of the first quarter. So again, a very, very different liquidity environment. This is the way to think about it, and I intimated about this a minute ago. When you think about the banking system and what happened to the banking system through the pandemic, so 1.1 trillion in cash assets goes to 3. Roughly $1 trillion of that is on deposit at the Fed, earning a whopping 5 basis points per annum. Clearly, that's below banks' cost of capital, and they don't want that cash. It bumped them up against supplementary leverage ratios at the end of the first quarter, second quarter. They had to issue massive amounts of bonds, 50 billion in issuance, each of those 2 quarters for the biggest banks. They're not earning out their cost of capital by leaving that on deposit at the Fed. Their ratio of loans to assets went from 60% to 50%. Securities holdings went from 17 to 22. Again, buying Treasury securities at their cost of capital is a losing bet over the long run. Subsequently, if you think about what happens to the banking system when this cash gets drained out, now the Treasury is going to rebuild their balances once the debt ceiling deal is done to something like $500 billion. That'll pull money out of the banking system. That'll actually make the banks more profitable. Should make their return on assets and return on equity go up. And that's good news for the banks and for the core economy. Profits are the mother's milk of growth, sort of thing, I think is Larry Kudlow's quote. That notwithstanding, this is actually good news for the banks, not bad news for the banks, and is in by no means a negative for the economy, even though the markets are likely to struggle, because as we know, monetary policy is a blunt instrument, and some of this cash went into all the wrong places. You saw when they sent checks to individuals early last year, how speculative fervor took off. We saw all the Treasury purchases that took place by the banks in the second quarter that reversed that early year rates rally. Again, this liquidity was just too much. It just flooded the system, and the banks choked on it, and they're better off without it. That is an important point. So if you then think about, okay, what happens to the markets? We think they'll struggle in the first half of the year through this process, but then the second half of the year will be better. And earnings seasons in particular, earnings reporting seasons could be good points in time for the market, because we do think we'll get strong earnings growth in 2021, stronger than market expects. Market's probably at 9%. We're at 15. We don't think we'll match that in S&P 500 returns. We'll probably get some multiple compression. So we're calling it barely getting to double digits, being back-end loaded, meaning most of the returns coming towards the end of the year. That's it for our market outlook. On the economy, the persistent pandemic effects, there's really 2 of them. One is deglobalization and the impact on inflation. It'll drive it up. The other is productivity, which is disinflationary. It will be important in terms of profit margins, but it won't be a complete offset to the deglobalization, higher goods prices, and a process that we believe is going to take place early in the year where goods inflation does start to come down. It's running above 9% right now. That'll come down, but as we transition the consumption basket, if you will, back towards services, we're going to find we have higher trend in services inflation because of policy. We're also likely to find we have higher trend energy price inflation because of policy. This is a key issue, and this will be the point when, we start to move some of the long-term terminal Fed funds rates up, real rates up, and the Fed starts to get a little bit concerned about just what the policy has done. That's when that we'll go through a process where team transitory is patting themselves on the back, and then they realize, this is not so transitory, because in our view, the only thing transitory about inflation in 2021 was disinflation in education, healthcare, and at the beginning of the year in housing. Those trends are likely to run stronger than they did in the 2010s for a whole host of reasons. The productivity story, though, is pretty good. It already started to accelerate late in the 2010s. 18 and 19, you saw it picking up in the service sectors. We've got a cool chart in the note you can look at around this. We do think we're going to have stronger service sector inflation. Before you go jumping on the Cathie Woods bandwagon, though, we would caution you that the 3 sectors that have been the biggest drag, what we've called the deadweight sectors, education, healthcare, and housing, are 3 sectors that have had an even bigger government involvement or role in them through the pandemic, and are not likely to be as quick to adopt technology that will cause significant disinflation in those sectors. So it's going to be harder because of that government involvement to really have service sector disinflation move beyond consumer goods and core services to areas where the government is more deeply involved, as we mentioned, education, healthcare, and housing. Now, both of these trends imply a very strong CapEx cycle. And not just CapEx into software, as was the case in the 2010s, but also into physical plant also into equipment. We think we'll have a very good CapEx cycle. That's good news for the industrial sector. It's good news for a couple of different sectors. It's good news for the economy. It's good news for margins. And that we think will be a key feature that will become increasingly evident in 2022. And labor dynamism has improved decidedly as well. It was really impaired after the global financial crisis. That's just turnover the labor market. That's good news for real wage growth, for labor productivity. Again, something of an offset. This is the reason why we think we're going into a reflationary regime, not straight to the 70s. I'll come back to that at the end of this discussion. So that's it on the economic outlook. A pretty good year for growth, but it will definitely be reflationary growth. So higher nominal GDP, higher earnings growth. Onto the political and policy situation. We all know we have midterms coming. We've got a chart in the note that shows just how much energy there is on the Republican side, just how confidence has plunged with independents. This largely explains why President Biden's approval ratings are so low. They may get something of a bounce as things calm down in 2022, but right now we're headed for a Republican victory in the House in the midterms and likely in the Senate. Now, this will not change the legislative agenda. The president can veto, but it does mean that any of this legislation that is expanding the role of the government will likely come to an end. They probably won't be able to get anything more done after the Build Back Better plan, but that leaves regulatory policy. So there's still lots of issues to be settled on the banking side, on the healthcare side. Just as was the case in 2010, a big Republican victory doesn't mean they can roll back Obamacare or Dodd-Frank. They can't roll back any legislation, but it does mean we won't get any more business unfriendly tax legislation, for example. On the policy side, we have a pretty lengthy discussion in the note about the terminal funds rate, where we think the Fed funds rate's likely to end this cycle. We're much higher than the market. We're higher than the Fed. We would note the market didn't really reach the terminal funds rate in 2018. The reason that the Fed had to ease in 2019 was because of a policy mistake. That policy mistake was the trade war that caused a global manufacturing and trade recession. Some might not view it as a mistake. We apologize if we've offended you in any way, but it clearly caused a global trade and manufacturing recession. That's why the Fed needed to ease. We did not reach the point where interest-sensitive sectors, housing, autos, durables, were getting choked off by a higher price of money. So we didn't reach the real true endogenous terminal funds rate. We also think demographics have shifted. Demand for capital is going to go up. Consumption is going to be much stronger this cycle. The household sector is in a much better place. Household balance sheets are much better. And we've heard some people describe this as a highly leveraged economy. It is a highly leveraged economy, but all the leverage is in the federal government, not in the household sector, not in the financial sector, not in the non-financial corporate sector. That has very different implications for inflation than when it's in the private sector. When debt is in the private sector, that is disinflationary or deflationary. When it's in the public sector, that's inflationary. Key point here, the strike price on the Fed put is going to be considerably lower than it was last cycle because of the condition of household balance sheets. Let's just think about net worth, and we're going to get an update on this figure for the third quarter this week. Household net worth fell from a little over $70 trillion before the global financial crisis. Over the course of 18 months, it plunged all the way down to $59 trillion. It took 3.5 years to regain that value. During the pandemic, it dropped from 17 to $111 trillion. In 1 quarter, it's now $140 trillion. It's gone straight up. Debt is lower, financial obligations are lower, net worth is much higher. There is no reason, given that asset purchases work through wealth effects, there is no reason that the Fed needs to cushion household balance sheets the way they did in 2010, 2011. That's our argument for why the Fed put is much lower. It's also the inflation story, of course. So that's it on the policy outlook. We think that the Fed is going to hike 3 times in 2022. We think they will probably start balance sheet runoff, and we think they'll be done with their asset purchases in March, April. Okay, on to asset allocation. We call it another difficult year for 60/40. That's because we think the total return on the Lehman aggregate Bloomberg Aggregate Index is going to be negative again next year. It should be marginally negative this year. It'll be more negative next, we believe. We do think it'll be a decent year for equities. It'll be back-end loaded, as I mentioned earlier. We still like the reflationary sectors. There's going to be lots of cross currents for the technology sector. You can read our note if you want to get all the details on that. We're starting to think a little bit about the mercantilists, China, Germany, Japan. Are they going to reach the point where they realize on the other side of the pandemic that their business models are no longer apt for the current environment and start to restructure? We look for Germany to be the first mover on that. But we'll be watching those sectors for signs that maybe we can start to fade our anti-mercantilist theme and find an opportunity to get long those sectors. We're still underweight them now, to be clear, but we do think they could become interesting at some point in 2022. So biggest risk for the year, straight to the 70s. We've talked a lot about how this period is very similar to the middle 60s when LBJ was elected, went about trying to right some wrongs. 25% of the population over the age of 65 had health care. That's why Medicare came about, but it did drive inflation higher. As Thomas Sowell says, there's no policy solutions, only trade-offs. Well, they've decided that a worthwhile trade-off is higher energy prices as well. So perhaps the difference between that period and the current period is rather than getting the shocks later, as we did in 1973 and 79 with the OPEC embargoes, we actually got a shock before the whole thing happened. So is there a chance we come out to the other side of this and inflation has skipped the reflationary period and gone straight to inflation like the 70s? It's possible. For us, that would be the biggest risk. It's not our base case. We think it's a fairly low delta. We do think inflation will cool next year, but this could be a short business cycle. So that straight to the 70s scenario is our biggest risk. And that's how we think about the markets for this year. So that's it for me this week. Again, I'm going to get to work straight away working on this thematic piece. If you're not already a subscriber, we'd love you to consider becoming one. Put a lot of work into this note. We think it's really interesting. We gave you a lot here on this podcast. That may change a little bit in 2022 as well. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thanks.